The Dunham Quarter in Twos gives you a concise outline of what we view as the most notable economic events that occurred this quarter, involving domestic markets, international markets, and the bond market, all in about 2 minutes. Investors began the second quarter with record inflation numbers and supply chain issues still at the forefront of their minds. As the second quarter continued, the unease unfortunately did not subside. The biggest question on investors' minds is whether rising interest rates will cause a recession or if they will successfully curb inflation. Just like a trapeze artist balancing above an anxious crowd of onlookers, the Fed tries to find a balance between high inflation and a possible recession caused by various economic factors, including rising interest rates. It was evident that domestic markets were beginning to feel the effects of the quarter's events, with the S&P 500 ending the 3-month period down 16.10% and the MSCI ACWI down 15.66%. Two sectors that did well this quarter were energy and commodities, further highlighting the need for low-correlated investments. Overall, the second quarter of 2022 saw stocks and bonds continue to fall, resulting in the first bear market since 2020. Just like the House of Mirrors at the summer fair, a bear market can be scary and hard to navigate. However, with the help of a well-diversified portfolio of investments, it's generally easier to navigate volatile economic environments. Russia's invasion of Ukraine continues to disrupt markets globally. As we outlined earlier, this has resulted in a rise in commodities and energy prices. The Eurozone is also combating inflation with rising interest rates, while trying to avoid a recession. In other parts of the world, emerging market equities had relatively strong returns. As most developed markets are tightening monetary policy to rein in inflation, some emerging market countries are keeping policy constant or even loosening monetary policy. This potentially makes them less susceptible to downgrades and to the U.S. recession risk. The Bloomberg Global Aggregate TR ended the quarter down 8.26%. The Federal Reserve raised interest rates by 0.75%. Balancing on a tightrope, the Fed treads precariously between avoiding a recession and trying to limit inflation. With a crowd of spectators cheering them on, only time will tell if they can pull off this balancing act. The continued escalation of the war in Ukraine could result in further sanctions that disrupt economic activity in Europe and create potentially significant agricultural shortages worldwide. As we finish the first half of 2022, it's important to remember that it can take a full year until we see the effects of monetary policy. Finally, it will be increasingly important for investors to make long-term, rational decisions rather than acting out of fear. Past performance is not an indication of future results, but history may show that it is better to view the moves of the Federal Reserve with a calm and steady mind. Just as the trapeze artist falls into the net and gets right back up on the tightrope, the market may surprise us with a comeback. Please subscribe to our channel to stay up to date on the latest Dunham insights.